We're going to calculate the stock price for Starbucks using prior financial information. The first step is we need the market cap, 92.4 billion. And they're trading at 78.69. Next, we need the free cash flows. Now, the best way to calculate the stock price for any company is to estimate their future free cash flows and then discount those amounts back to today's dollars. So that's why we're getting the FCF. The next part of the model, we need the net income. And the reason we don't forecast future net income is because the income statement reports a lot of non-cash items, and it also uses accrual accounting, which makes it really difficult to value a stock with those two parts involved. Last step is revenue. So now we have the financials, so we calculated the free cash flow. Now we need to look at a capital structure to figure out what discount rate we're going to use to present value the cash flows. So the interest expense is the interest Starbucks paid on its debt, $331 million. And let's see how much debt they have. We'll go to the balance sheet. We'll look at the no current debt. Long-term debt, $11 billion. So that's debt due beyond 1 year. So they pay 2.96% interest on the debt. And interest payments are tax deductible, so we need to figure out Starbucks' effective tax rate. And their income before tax is $4.5 billion. And income tax is about 20%, which sounds about right. So the cost of debt is 2.4%. Now we need to find the cost of equity. And to do that, we need the beta. And the beta is 0.8, so it's a pretty stable stock. Under 1 means it's not volatile at all. So the cost of equity is 8.46%, which is a lot lower than most companies. You can see it's a lot more expensive than debt. And the reason that is because equity is lower in the capital structure of a company, so therefore it's more risky. And now the WACC, the weighted average cost of capital, is 7.81%. So that's the cost for Starbucks to obtain financing, 7.81%. So Starbucks needs to generate at least that amount of profit each year to add value to its investors. If it's below that, then it's not adding value to its company. So now that we have the discount rate, let's discount the future free cash flows. And then we calculated that up here, the free cash flows for 2020, 21, 22, and 23. And we did a terminal value, which means future free cash flow 2024 and beyond. And we used a Gordon growth model to do that. And then we discounted those numbers back to today's value. And the value of Starbucks, according to the model, is $112 billion. And if we divide that by 1.1 billion shares, we get a stock price of $95, which implies Starbucks is trading at a discount, a 17% discount, since the stock is trading at about $79. So you can see the last 5 years of Starbucks stock. It actually traded around intrinsic value for several months, and then Corona hit, and it dropped like everything else dropped. And now it's back up a little, but still trading at a discount. So the current price of a stock usually does not line up with the intrinsic value because investors feel the future of a company does not warrant the stock price of $95. They feel it warrants a stock price of $79. And the indication of a stock price is supply and demand of the market. That drives the stock price, not what the company's worth. Some companies are worth nothing. They're worth negative because they have more debt and more expensive, but yet the stock is not negative, of course. So if you were to look at 10 analysts on Starbucks and see what they predict, you would see something like 5 would say Starbucks is a buy, and the other 5 would say Starbucks is a sell. But each analyst uses their own models and their own assumptions. But you never actually see the models. But this is my model, in my opinion. So I hope you liked it, and come back again. Thanks for watching.